Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. What we like to do on the weekend, of course, is to come back here, outline the base case hypothesis in case you're new, and then check in on it, because if it's starting to invalidate, I want to know in the first instance. And of course, I want to be able to adjust my position in if the market provides me with new data. If the converse is true and everything is still going according to plan, everything is still operating within the realm of expectation, then I can at least have confidence in my assessment that my read on the market is correct and that everything is, largely speaking, going according to plan. So from the top, the idea was pretty simple. The idea was that at the lows for the stock market, everyone was too bearish, sentiment was too one-sided, and we were going to experience some kind of big push to all-time highs. There would likely be rate cuts somewhere close to the top, and then we would have a meltdown, a global recession, and perhaps even see deflation. A big part of this assessment was that we were very late in the longer-term multi-decade cycles. You can see here this parabola goes all the way back to 2000, and that this indeed has been framed in a macro bull market that spans nearly 42 years. Fast forward to today, and as far as I can tell, things are moving more or less in the expected direction. So I'm going to get to the charts at the end as always, and I'll show you the invalidation levels where things start to go wrong from a technical perspective. But for now, at least, the expectation was that we would start to put in a blow off top. And as far as I can tell, it's been a long time coming, but here we are starting to set what looks to be a third angle. So far, so good for the stock market. For Bitcoin, my expectation was that we were going to put in an all-time high before the halving, see a top before November of this year, qualifying it as a left translated cycle top, meaning the peak comes to the left-hand side of the halfway point in the 4-year cycle, measured bear market low to bear market low. So any top that forms before November of this year will qualify as left translated. And because the peak would have come earlier in the cycle than we're used to seeing for Bitcoin, that would of course imply that there is more time left in the 4-year cycle, and thus more time than we are used to seeing for Bitcoin would be spent in its first true secular bear market decline. Similarly to how the stock market is putting in a blow-off top, framed within the context of a much longer multi-decade cycle, I have been speculating that Bitcoin is probably doing a similar thing. This is a chart that I've had pinned on a whiteboard in my office since back in 2020, you can see here, and I was expecting to see a right translation followed by a left translation, and this would give us a 16-year longer-term super cycle. And so again, I sit here and tell you that so far, things look okay. Things seem to be moving more or less in accordance with the expectations. I have one more chart that I wanted to show you, which I think also feeds into this idea quite nicely, and that is that you'll notice here, these are 12-month candles, by the way, and you can see this is a 16-year sideways consolidation that occurs on a declining momentum oscillator. We also have another 16 years of sideways consolidation for the stock market that occurs during a declining and resetting momentum oscillator. We see the same thing here for 14 years, declining momentum oscillator. The same thing here for 14 years, declining momentum oscillator. And at the hard right edge, whilst we are still framed within this blow off top for the stock market, whilst I still think we have some time to run further to the upside, the momentum oscillator, as you can see at the hard right edge, is suggesting that if this thing continues to reset, okay, then whenever this top comes in, that high may well remain the high for somewhere in the neighborhood of a decade and a half measured from the start to the finish. So already right out the gate, we have rather an unpopular idea, and that idea is that we're not going up only forever. It's not early in the liquidity cycle. There's probably not many months of bull market, even years of bull market left. And instead, I am here to suggest that in line with my expectations, that in line with the charts, and of course in line with my expectations for Bitcoin, I am here to suggest that if indeed this thing tops in the not too distant future, if indeed we do see that third and final angle set and broken down, that the stock market high may remain the high for around a decade. Fast forward to today on Bitcoin's left translated idea, and it doesn't look too bad to me. I know sentiment out there is really bearish at the moment. I know a lot of people are calling tops here. A lot of people are saying that we have to go way lower. And as ever, we'll get to the charts at the end and I'll show you where things become invalidated. I'll show you what I'm looking for in terms of daily cycle counts and all of that stuff. But as far as I can tell, when we zoom out and take a look at this chart, it doesn't look too bad for me. This is the only missing piece, the only missing component of my hypothesis, and that is that I was expecting to see Bitcoin start to set a third and final angle in the not too distant future up towards a left translated cycle top. Now, whether or not that comes is, of course, to be determined. I think there's a good case, as I'll show you at the end, that we're going to make a cycle low and then set that third and final angle. But objectively speaking, until we start to roll over and truly break down, okay, below this prior low, then this is still in play, albeit slightly behind schedule. And so that is the base case hypothesis. Like I said, that we were way too bearish at the lows. We would have these blow off tops. Bitcoin would left translate, and then everything would come tumbling down, culminating in a global recession and perhaps even a deflationary bust. One of the reasons I suspected we would continue to see inflation come off, and this of course leads me into my second unpopular idea, and that is that inflation is not actually sticky. So when you come from a highly inflationary environment towards a deflationary environment, there is a period in the middle where the market tends to rally. That is known as the Goldilocks zone. That is why I believe the market has caught so many people offside. That is why we didn't get the retest to the lows. Everyone kept hating and doubting this rally the whole way up. And for Bitcoin, remember in Bitcoin, everyone was hating and doubting the rally the whole way up. Everyone was expecting new lows in here. Everyone was selling retracements in here. And only at the new highs, when Bitcoin finally confirmed to the market that it did make an all-time high before the halving, did people start to go looking for an answer and an explanation to how they messed this whole move up. Same is true of the stock market. This has been the most doubted, most hated rally of all time, and we've even seen this from an institutional positioning perspective. They have been shorting and doubting this rally and continue to do so even at the highs of today. So a very, very unpopular idea, but that's the way I like them. Speaking of unpopular ideas, as I said, inflation is sticky, is the popular idea. Inflation is going to continue to resume to the downside, and in rapid fashion is not a very popular idea. The reason I am confident in this assessment is because anything you do to the M2 rate of change tends to present in the US inflation data with around an 18-month lag. Since we had this move down, a sideways wobble, and a resumption to the downside in the rate of change of M2, I have been suggesting that what we are seeing in the US CPI print is a down, sideways wobble that everyone is confusing for sticky inflation before the resumption of further downside, meaning continuation of disinflation before ultimately slipping into asset price deflation. Something else I've been using to track this is the TMC Global Credit Impulse, which typically leads CPI by around 18 months. You can see here, this has been telling us to expect continuation of disinflation followed by a short period of deflation for some time, and thus I still continue to expect to see inflation come off. Here in the UK, we have officially hit 2%, which is the Bank of England's target for the first time since 2021. And taking a look at the CPI data, you can see right here, down, sideways wobble that everyone is confusing for sticky inflation, followed by the resumption of the downtrend. This does not yet include the most recent print, which would put us somewhere in this neighborhood. And thus, all we need to do is walk forward another few weeks, get to the next CPI print, and see that continue to come in colder than everyone expects. And I really think that we will have the setup here ready to see inflation start to fall very, very rapidly towards deflation eventually, catalyzed by a stock market top and capital flight from risk into the dollar, driving a very, very strong relative dollar. That is, of course, characteristic with deflation. And speaking of deflation, again, not a popular idea, but here we have core CPI excluding shelter showing a print month over month. That is deflationary. So I think the stars are aligning here to see the continuation of disinflation. As ever, we'll keep taking it 1 week at a time on the deep dives. We'll keep taking the market structures 1 day at a time on the charts. And we'll keep checking in on this thing until it invalidates. Of course, if we get to the next CPI print and what we start to see is inflation actually become sticky, then we can cross this one off and say, do you know what? That's not actually in play anymore. But if this thing continues to move down, then I will continue to stand by this posture. I will continue to suggest that everyone is wrong about sticky inflation. Everyone has been conditioned and programmed to believe that based on the headlines we see and people parroting each other in this space. And again, I'll be suggesting to you that taking a contrarian approach is probably the best idea here. The next thing I've been looking at is the US consumer. The US consumer is not in a good way. Consumer credit card debt has just topped $1 trillion. And of course, this is currently having to be serviced at a very high rate of interest due to the interest rate hikes. Meanwhile, household excess savings has slipped to the lowest levels that we've seen in 5 years. So at a time when the consumer has record amount of debt at the highest interest rates we've seen in a very long time, it also has no savings. And as if that's not bad enough, just how expensive is this US consumer debt? Well, personal interest payments as a percentage of disposable income has just spiked to 2.5%, the highest that we've seen since the 2008 financial crisis. So take a look at this. Alarm bells should be ringing here in my humble opinion. And whilst I am still calling for higher prices in risk in the short to medium term, I do think we are not too far away from seeing a global recession take hold. I think it's going to sneak up on a lot of people. because everyone has their attention in the wrong place. Everyone thinks this bull market has plenty more legs, can run well into next year because inflation is sticky, higher for longer, and I'm here to suggest that that is not what my analysis shows. Furthermore, 37% of Americans have paid a late fee on their bills in the last year, and credit card delinquencies are up big too. Consumer debt is at an all-time high, as I was just saying. Once again, I am here to say that the consumer is not in a good shape, and of course, if the consumer is not in a good shape, it doesn't have much money to put into the economy, and thus we would be expecting to see economic slowdown, synonymous with recessions, of course. To make matters worse, when we look at the unemployment data, here we have in yellow the temps, lead-in unemployment lower, not a good look. And of course, synonymous with recessions, just like the expected increase in the initial jobless claims data. I understand that at the moment there seems to be a pretty big gap between here and here, but if we look back at prior occurrences, you will see risk happens fast, unemployment happens fast, and recessions happen fast. It gets even more concerning when we take a look at the JOLTS data, which at the hard right edge is falling off of a cliff. And strangely enough about all of this is it was predicted 12 months ago by the existing home sales. Whenever we get a decline in existing home sales, around 12 months later, we see these spikes in unemployment synonymous with recessions. You can see all the prior instances here, 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 and here. And at the hard right edge, we are now over 12 months forward from seeing the existing home sales collapse. And of course, right on schedule, we are starting to see that unemployment turn up towards recessionary levels. Not to mention, we are starting to observe this when we take a look at the US GDP figures, which, again, it doesn't take a genius to point out, are declining. So if I stop here as a little checkpoint and just recap exactly what's going on, stocks and Bitcoin starting to look quite blow off toppy. The only missing component is Bitcoin set in that third and final blow off top angle. Inflation is likely to continue to come off despite that not being a popular narrative. The data suggests we are going to see continuation of disinflation before ultimately asset price deflation. Again, I'm here to say that is not a popular idea in this space. The consumer is in a very, very bad shape with record high debt, record low savings, and is even about to possibly lose its job. This is because the unemployment is nearing recessionary levels, as I've been showing you so far. And all of this is occurring as US GDP is rapidly declining. And so with all of that said, it seems to me that one, the stocks and risk are getting into that neighborhood in the not too distant future where we are going to have to entertain significant tops coming in. The macro data, as far as I can tell, is quickly suggesting we might see a recession in the not too distant future. And this is where it starts to get really interesting because we have divergence between the Bank of England and Fed with the rest of the world pertaining to interest rates. This is another idea of mine that is absolutely not popular. It has not been popular. And that is that the Fed is going to be forced to cut rates much sooner than most people are anticipating. A lot of the reason I say this is because of these points right here. But whilst the Fed keeps coming out and talking tough, convincing your average market participant that no rate cuts are coming anytime soon, we are now starting to see a divergence occur. The ECB has cut rates along with the Bank of Canada, Sweden, Switzerland, Hungary, and the Czech Republic. Typically, what we do not see is a bunch of these banks start to cut rates while a few of them do not. Therefore, I've been assuming, again, the majority of the market is positioned incorrectly here. They are not expecting to see rate cuts anytime soon. But to that, I simply say we don't often see divergences occur between these central banks. Where some of them go, the rest tend to follow. And thus, I think this is a piece of evidence to suggest the Fed will be cutting sooner than it is letting on. Not only that, Switzerland just did another surprise rate cut as of this week. Again, speaking to probably seeing the Fed and the Bank of England follow in the not too distant future. As I was saying earlier as well, the Bank of England, whilst it is currently holding interest rates higher, has now got inflation down to its 2% target. And if you're not convinced by what I've said pertaining to interest rates, to that I simply say, tell that to the bond market. Historically speaking, in green, we have the US 2-year bond yield. This, when it moves lower, tends to lead the onset of a Fed cutting cycle. We see that in every one of these instances, 2-year yield lower, onset of a Fed cutting cycle shortly thereafter. And I have been suggesting that this is the signal because all it would take is a US 2-year yield to start to roll over and decline. That will tell us that the bond market is calling the Fed bluff. The onset of a cutting cycle will be coming in the very, very short term. And the reason I think this is so important is because, again, the market typically gets interest rates wrong. The market seems to think that somehow interest rate cuts are bullish. Why then is it that at this chart, I have had do they cut here at the top marked the whole time? And of course, the answer is simple. When we see the Fed start to cut rates, historically speaking, a market top comes in within a couple of months of the onset of that cutting cycle. We saw the same thing here. Fed starts to cut, stock market goes risk off. This was the GFC, of course, and we saw the same thing here in the dot-com bubble. Fed starts to cut, market top comes in. In case I didn't mention it, this of course was the C19 plunge. So if indeed we see the Fed cut rates in the next meeting, or even a surprise cut somewhere in between, is it reasonable to expect a top to come in for the stock market in the not too distant future? I would suggest to you that yes, it is. And I also think, as I was saying earlier, not a popular idea to be saying that the market might top within just a couple of months, but historical data tells us that if indeed we do see this cutting cycle begin, then the stock market is likely going to top in the not too distant future. And thus, with the central banks continuing to cut around the world, I don't expect this divergence to last very long. As I was saying, I believe this 2-year bond yield is the signal, because historically speaking, once we see this thing sell off, it is the bond market calling the Fed bluff and telling the Fed that it will be cutting rates very, very soon, at least much sooner than your average market participant believes. And when we get into the TA section, you can see right here, I've got the US 2-year bond yield. Okay, is this not breaking down? Now, all it will take is a little bit more resumption to the downside, and we will have morphed, when we go back onto this chart, into a look that looks a lot more like this. What do you think happens thereafter? I would suggest to you that this thing starts to break down and the Fed is forced to start cutting. We can see this breakdown even clearer occurring on the US 10-year yield, and this is why I continue to say, if you don't think rate cuts are coming, tell that to the bond market. So it is a wild time to be alive, with all the macro data suggesting that we are going to see a recession in the not too distant future, big spikes in unemployment, inflation come off very, very rapidly, and likely rate cuts that mark the top of this blow off top, or at least close to it. For me, the only missing component is to see Bitcoin do Bitcoin things. So with all that said, let's get into the charts. I'm going to start with the dollar, which I also believe is another warning sign, okay? If the Fed does not cut rates in the not too distant future, then we're going to continue to see relative dollar strength. And if indeed we continue to see relative dollar strength, okay, then we've got a situation where the stock market and risk is putting in blow off tops whilst the dollar is also running higher. This is starting to look an awful lot like it is setting up for a deflationary bust. This is starting to look an awful lot like we've got a dollar milkshake type deal in play. And frankly, I think all paths lead to the same place, because even if this thing does break down rapidly into a 3-year cycle low, all that will do is fuel the final leg higher in the blow off top before ultimately we find a 3-year cycle low, risk tops and comes off, and then of course we see that deflationary bust. So in amongst a sea of the liquidity cycle has just started narratives, higher for longer narratives, no way Bitcoin tops out until late next year narratives, I'm here to tell you the bond market, the dollar, and the current structural setups do not support any of these ideas or claims. As ever, I am open to being proven wrong, but as yet, I haven't seen a single invalidation occur. For the stock market, we continue to expect to see this third and final angle come in, lose this third and final angle in the next couple of sessions, and we might be looking for a half cycle low, but I do largely suspect this thing to continue to run higher. As I've said multiple times, there are essentially 3 scenarios from here. If we continue to accelerate in a third and final angle, then we will have this situation where we have put in a big parabolic blow off top, framed within a macro parabolic blow off top, and that when that top eventually comes in, it's probably not getting recovered for a decade or so. Up here, if we get anywhere close to this, I will be looking not only to exit the markets, but to flip short and be looking to guide members through what I believe will be a deflationary bust and a recession. That is one scenario. Now, if you don't like the idea that there's not much runway left in terms of time, what you really need to see is us come down here and hold this second angle for some time. So if we do something like this over the coming weeks, then we at least have a chance at pushing this bull market finish date out by a few months, if not more. But for me, major invalidation occurs on losing this second angle. We break down from here and lose this second angle by confirming it with failed daily cycles, then that is me saying that's it, the market has topped, at least a major top until the next weekly cycle low somewhere around October. And I would suggest that probably by the time we get there, the economy is just going to continue to worsen and worsen. That recession will probably have taken hold, and it will be tough times for the stock market and the economy for a while thereafter. We can see this blow off top occurring even more in the NASDAQ as we speak. Okay, it looks even more vertical. Again, the same thing applies. Continue to accelerate to the upside, and I think we've got a major top and a blow off top coming in. I think we're going to see a big breakdown, and I think tough times are coming. I think if you're in the camp of people
that believes we've got plenty more runway and bull market left, then you need to see us come and grind this second line for a while. And as ever, break down from that second line. And I think we've got bull market invalidation. I also think what we've got, once confirmed by failed daily cycles, is a major top in place, at least until that October weekly cycle low. To be honest, I doubt we come swinging out of that cycle low anyway. The Dow Jones continuing to, roughly speaking, grind higher. So long and strong there. And similarly, I will be looking for a third and final angle to come in the not too distant future for the Dow. I'm also looking for breadth to widen in the form of the Russell 2K moving higher. And this is unusual. Normally towards tops, what we see is narrowing. I think this time around, we're going to see rotation perhaps and see this breadth widen a little bit. That's to be determined. For now, though, it is still holding above its range break. So that is something to take note of. I think we've got a new weekly cycle for oil. I see a lot of people talking about what are the implications for this for CPI. Is this going to cause inflation to be sticky? Is this going to drag CPI higher? I really don't think so. I think this is just going to end up being a left translated weekly cycle, meaning we get a few weeks of upside, perhaps something like this, followed by a rollover to new lows. Somewhere in this neighborhood, I will be looking to short it, but I think it's too early in the weekly cycle to go looking for tops just yet. I do, however, maintain that even if we do get a breakout of this blue trend line that goes all the way back here, I don't think it will be sustained. I think it will morph into another look like this, and ultimately it will probably roll over because all of the other metrics suggest we have inflation to continue to come off. Meanwhile, gold put in a fake breakout this week, seems to be rolling over. I'm in the camp of people that now thinks this is a day 9 or 10 high, day 10 left translation, moving into that next daily cycle, possibly one thereafter. For me, the time frame is mid to late July for a weekly cycle, and that is where I'll be looking to get back to full exposure on the precious metals and related positions for level 3 members. Silver confirming this look even more. Fake breakout, rejection at resistance. I suspect this thing continues to the downside well into July. And then once we're in July, I think we'll find some weekly cycles and it should be go time. The short I have on VNQ is still boring me to death. Very, very minimal risk. Stop is choked up. So we'll just keep shorting it and see what happens from here. And last but not least, Bitcoin. Bitcoin is getting dangerously close to a daily cycle low, somewhere in this neighborhood, which will be around the 29th of June. It enters, as of Monday, the timing window to see a cycle form. So I would think we're going to get that in the not too distant future. I'm hoping we come swinging out of here. And the reason I say that is because, one, that would enable me to continue to stay with this current posture, that my read on the market is correct, that we have got third and final angles, and the whole thing is going to come tumbling down in a deflationary bust and recession. I've been making the case that Bob Lucas has shown a second scenario, and that scenario was another consolidation cycle before resumption to the upside. Now, from a cycle perspective, there's nothing wrong with seeing something like this, followed by off we go to a right translated cycle. Nothing wrong from a cycle perspective, but I think we have to ask ourselves the question, if Bitcoin rolls over from here and does another consolidation cycle, by the time we're in this neighborhood, if the stock market has indeed blown off, right, if we're somewhere up here for the stock market and it's about to come tumbling down, if the dollar continues to strengthen, if we do indeed see unemployment start to spike and all the other things I've discussed today, then does Bitcoin suddenly become the ultimate risk-off asset out of here? Don't get me wrong, I would love to see that, but I think Bitcoin will continue to be treated like a risk asset probably until the next cycle. And thus, even though cycles permit this up to a right translated cycle, I would suggest to you that if we don't come swinging out of here like this, and instead we do roll over in another consolidation cycle, to me, that has ominous implications for Bitcoin, and I would largely expect it to continue to act like a risk asset and follow the stock market to the downside. So I do think we should all be championing and hoping to see this third and final angle come in, because I just don't think the economy and the unemployment data et al. Can continue to support a right translated cycle by the time we get into this neighborhood. I'll also point out here, if we go blue, okay, blue is our one shot, like I said, to come swinging out of here. Notice to all the people that said Bob took the left translation off the table, that to me still has plenty of time before November to qualify as left translation if we do something like this and then crash, okay? So I think anything and everything is on the table. I don't think we should be championing this unless something starts to really, really change under the hood, unless somehow we start to see huge growth, consumers improve, unemployment suddenly fix itself, or an outright return to QE and Fed balance sheet expansion. But as ever, we'll keep taking it one day at a time. We'll keep being open to all possible outcomes. Certainly, invalidation will occur for this move here for Bitcoin. I forgot I didn't state the invalidation. If we come down and find a cycle low, then roll over and fail the cycle, meaning we trade below wherever the cycle low forms. That right there is invalidation. It will also be a breakdown of the second angle of attack. And for me, that will tell me that that probably was a left translated cycle top, and Bitcoin is going to be in a world of pain for a while. So For now, as ever, cautiously optimistic, hoping to see that third angle. That would make sense. The stock market, the crypto-related equities, they're all kind of suggesting to me that's what's coming. But as ever, we'll take it one day at a time and see what the market can give. If you are a level 3 member, look out for the members only video I'm about to post for you guys as always. For everyone else, I hope you consider what I said today. And until next time, have a great weekend. Take care from me. All the best. Cheers. Bye.